Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. Hopefully you've all had a smashing weekend. This is going to be your daily cryptocurrency market update. We're going to be sharing quite a lot of thoughts. We've got some major news to go over, like the Federal Reserve has essentially called for an emergency meeting tomorrow. This is genuine. This is the Federal Reserve official website. I reported this on Twitter. For those of you that aren't following me on Twitter, well worth doing so because we post some very valuable, often in the form of retweets, information that is going to all play into the crypto market and markets across the board. We know the correlation that we have. This is very, very significant and thought-provoking in the sense that what we've seen this week is we've seen the Bank of England have to step in a time where they're kind of doing quantitative tightening and kind of also provide quantitative easing. So it's kind of contradictory what the Bank of England are doing, but they've had no other choice to do so. This is leading people to start to talk about a pivot coming in regards to rate hiking. So we've seen a lot of aggression. We've seen a very fast move from the zero mark to where we currently are. They've had to do this fast because they know that they only have a window to get as high up as possible in case something goes belly up and they need to revert that, if that makes sense. So they need that wiggle room. They need some sort of, we don't just have to go from where we are to zero. We can maybe go back to half as much in terms of interest rate hikes and so on and so forth. So this is going to be a real thought-provoking video, I guess. We are going to be looking at some tweets. This is one that we reported on a while ago now, actually talking about that Larry Fink, not that long ago, sold 20% of his BlackRock stock. We gave this as a kind of indicator that isn't good. You know, he's the largest hedge fund manager that there is. BlackRock, a $10 trillion asset managing company. And if he's selling stock, remember the last time that he did that was just before the March 2020 crash. We told people that was a bad indicator. Also going to be looking at some tweets from Michael Burry. And then actually to top everything off, there are lots of rumors about Credit Suisse and them essentially going insolvent or potentially, collapsing. This would have huge contagion, just like your Lehman's did. And other kind of explosions in the financial markets that we've seen similar regarding banks. So Credit Suisse, CDC's credit default swaps closed to surpass levels last seen during the great financial crisis. Tick, tick, boom. This is what I mean when I say that we are not investing right now. It's not because we don't love the cryptocurrency market, we don't believe in it, our vision doesn't align with it, and certainly we don't see huge opportunity from an investment point of view. We do. It's just that right now we understand that this is, in my opinion, you don't want to be swimming in shark-infested waters. You want to wait until, calmer seas come along. This is, when we're pricing things into markets are forward-looking. So we know really the main driver of markets, and I will find it for you guys, is interest rate rises. So this is, and essentially thus liquidity. It's why we've seen the dollar get a huge bid. There's a huge correlation here, and I'll show you that now. So this is a 30-day Fed's fund rate. We've also done this in the form of looking at the euro dollars. Just a little refresh for people that are new to this. I don't see any other YouTubers talking about this. This is interest rate rises, okay? And you can see the correlation here. And you can also see this is interest rate rises. So going down means interest rates are going up with the Dixie, if I have it. So it's natural that when interest rate goes up, your currency is offering a higher yield. You're taking liquidity out of markets. They're doing quantitative tightening. So they're no longer, as they have really been since 2008, propping the markets up. So they're falling under their own weight. We can also put the M1 money supply on this just to really complicate everything. You can see interest rate rises perfectly. And this is the futures. So this isn't the actual Fed's mandate. So in the sort of lighter or the yellow, you can see interest rates start to go up. The money supply drops after they've been very lax about it, and we've seen huge proliferation of the money supply. Thus, markets have done what they've done. Your risk on assets speculating, looking at crypto, but also you could pull the NASDAQ up here, sold off in speculation of this. And of course, the dollar got a bid as people see that sort of flight for safety. So this has been the main driver. And really, when people are pricing things into markets, they're looking at this. The majority looking at this. You can see that because this is what's moving markets. What I think people aren't pricing in is serious systemic risk. And we saw that last week with the UK bond market. Certainly the 10-year gilts got absolutely killed. Gilts are supposed to be a very low risk fixed income product that is sort of government backed, if you will, or certainly the Bank of England backed. Now, the reason that most pensions are stuffed with bonds and treasuries is simply because it's mandated by the government for them to do that, because in the name of stability. We saw huge amounts of instability as we saw the pound roll, and this caused the Bank of England to step in and actually go back to proliferating the money supply. So we're going to talk about all this, and we will do some TA on Bitcoin, but it's important that we understand the sort of macro picture here. This meeting is not, it wasn't scheduled, this meeting tomorrow. It's really an emergency meeting where they are going to talk about the rate hiking regime. This is the Fed, obviously not the Bank of England. We know that they've already came out and told everyone what they're doing. We're also seeing a similar thing in Europe. You know, we know the ECB actually had to sort of prop up the Italian bond market, and this takes us into sort of Japanese yen economics. And we're getting kind of deep into it, but the overall picture here is quantitative tightening bad for markets. We've seen last week the Bank of England, even though they're doing quantitative tightening, do also quantitative easing. The real question I think people are asking is this going to lead the Fed to have to do a similar thing? And the answer I think for now is no. The Fed's markets are getting very much propped up, or the US markets are very much propped up by capital from other countries coming in and actually preventing it from seeing a similar collapse to what we saw in the UK. So they aren't at that point where they'd have to do that yet. So I don't think we're going to get any kind of a pivot. Do they maybe say we're going to take things a little bit less aggressive? Potentially. But the problem is, and the problem with the Bank of England doing quantitative tightening for the reasons of fighting inflation and now going back to stimulating the bond market for now, but it's still a proliferation and a further run on GDP, or sorry, the deficit, I should say, is they are adding more inflation to, or they're not, you know, they're not kind of set on this path of that the Fed's on of quantitative tightening. They've kind of pivoted somewhat, but still haven't, if that makes sense. And they've just kind of halted things whilst things sort of stabilize. The problem is that the problem is already there. So it's going to be very, very interesting to see actually what comes out of this meeting, and do we have any kind of a change in the path that we've set out, that we've had set out by the Fed as a result of what we've seen taking place in the UK and obviously Europe. And you know, we know Germany, I think it's a $200 billion dollar equivalent bailout package. So it's interesting, the kind of dynamics of what's going on, and it's absolutely going to move markets. You guys know, and let's bring this back into Bitcoin, that Bitcoin has just moved in tandem with everything that we've just spoke about in terms of interest rate hikes. It's moved in tandem with the stock market. And we do think you are going to get that next leg lower eventually. But we've spoken about a number of possibilities in regards to how we get sort of down to 13, 14K. We've got this head and shoulders pattern. You know, we were really one of the first to call this. We're seeing more and more people call it now. And we did say there is still the potential for more of a pronounced double peaked right shoulder before we get that continuation to the downside. But it really depends on a number of things. We've seen crypto actually hold up rather well against the stock market. You know, it largely actually also depends on what the dollar does this week. So the dollar's been absolutely raging. We did say coming into this grey box that you were likely to see some sort of a pullback and some sort of resistance. We have indeed seen that, some sort of a ceiling. I do think the dollar is likely to push higher. Lots and lots of people are looking at this 120 zone and looking for sort of a double peak here. Very probable. But really, when we're looking at crypto, whether we have that double peak or what it does is really going to be dependent on the dollar and certainly how that market opens tonight. And then, you know, the dollar, I think, is really going to drive everything. Remember, we've got that emergency meeting. What comes out of that? I'm sure there will be some reports of what the Fed has spoken about and some of, you know, what has or hasn't been resolved and how this is going to affect policy. That's going to play a big role in the Dixie. And the Dixie, actually, the one thing that I've learned about markets is, you know, this looks like it's due a pullback. But often, certainly in times like this, things will completely overperform any expectations. So this could continue to go. There's no reason that this couldn't continue to go and see further upside. It's going to be bad for markets. For me, we're really just waiting. You know, we're on this kind of ledge. Yesterday, we looked at prior, and we may even have the chart. Yeah, yesterday we were looking at, you know, people were essentially saying, okay, well, this is holding very well. But you did a similar thing here, and you did a similar thing here in the exact same manner. you know, we haven't got that sell side yet. And one reason crypto's been holding up very well is just because of where it's at technically. You've also got huge amounts of bids under here. And those bids come in the form of stop losses that will be sell side pressure. So people, the risk to reward makes sense to bid here and actually go long until it doesn't. So people will have stops here that they're probably not even that worried about getting hit. So once this falls and you get through this area of liquidity, it's a straight drop down, in my opinion, certainly to 15K, which is a nice round number, psychological number. People will bid there. And then I do actually think that we will spill through that if we get that sort of volatility. Could potentially Credit Suisse or anything else going on be the catalyst for that volatility next week. We will see. This is the collapse in Credit Suisse's share price is of great concern from $14.19 in February 2021 to $3.90. Currently, markets are saying it's insolvent and probably bust. Now, there was lots of talk about a credible source reporting that there's going to be a major bank sort of crash or a major player in the banking industry crash within Europe. Potentially people are looking at Credit Suisse. The credit default swaps are going through the roof at levels that we haven't seen since the great financial crisis. And this really actually, you know, something that we've been maintaining ties in with our thesis that, you know, we do think this is a sort of 2008, 2000s environment. Yesterday, we looked at, this is an overlay in and this may have been a weekly overlay. Yeah, this is a weekly overlay in the blue of 2008. We looked at all this yesterday, guys. If you didn't watch yesterday's video, it's well worth a watch. But it does look very much like we are entering this kind of a period. And I don't think we've seen that kind of capitulation event that the yield curve is predicting just yet. So going back to everything, we don't think now is a potentially a smart time to be an investor in what is already a very shaky market, given the sort of regime that's in place, monetary. But there's lots of sort of outside. We don't want to be swimming in shark-infested waters. We did report this. This is from Gagavin talking about, you know, this is from the 8th of April, guys. So we told you, and we actually reported about this, saying, look, Larry Fink just sold his stock. You can see the last time that he did this was before the March 2020 crash. How did he know? I don't know. Pure speculation, I guess. But this guy seems to be very good at when he sells. You should be doing so too. He's not doing it for retirement. He's more doing it for, you know, he knows something's coming. And since then, BlackRock share is obviously down, but markets have sold off since the 8th of April. Let's use the SPY. Let's get rid of all this. Significantly. So where is... or sorry, August, the 8th of August. Markets are down nearly 14%. Now, that's a huge move for the stock market. Let's get into a little bit about what Michael Burry is talking about. 13.48% of stocks closed above their 200-day moving average yesterday. Bottom in 2009 was 1.2%. Bottom in 2020 was 2.8%. Currently at December 2007 level. So Michael Burry still agrees with a lot of, or I agree with what he's saying here in regards to the environment that we're in. You can see this. Yeah, just stay safe out there, guys. It's not really any positive news, you know, in regards to the fact that I do think things eventually are going to come lower. Do you see that sort of stab to the upside before we get that continuation to the downside? Potentially, you know, there is always as well the potential that this is a double bottom. But for me, I just don't see that being the case. I think this is more of a period over here, and of course over here, and even, you know, we're playing out this kind of price action where we have a huge amounts of stop loss here. We kind of form this floor in this range only for us to take it, and that to be the very catalyst that sees that further continuation to the downside. Lots of risk on the table, ladies and gentlemen. A little bit of crypto news. Nexo labeled address withdraws $153 million in wrapped BTC from MakerDAO. Why is he doing that? Why in this sort of proportion? We will see. Maybe an indicator that, you know, people are looking to get their capital and take it off potentially high beta, riskier altcoin derived products. Just speculation. All I've got for you in this one, guys. If you enjoyed the content, like is always appreciated. So as a comment, and I look forward to seeing each and every one of you in the next YouTube video. Thanks a lot for watching, ladies and gents.